Hey, Cecil Robles here, and hey, welcome to another market review video here. In today's video, I want to show you how to deal with choppy markets. You know, choppy markets are many traders' a worst nightmare. You know, they don't know how to deal with them, and therefore they shy away from them. But the problem is that a lot of times a market that is in a choppy market has just come off of a big trend. Today we're looking at the dollar yen, and the dollar yen had a massive uptrend, as we're about to see. As I back this out, you can see the massive uptrend that the dollar yen had. Well, a lot of times after a big trend, the market goes into a choppy environment. As you can see here, trended up, pulled back, trended up, pulled back, tried to retest here, pulled back again, tried to retest, and then it got into a really tight, choppy market right here. I've drawn a couple lines on the screen, these two red lines. You can see that the market stayed fairly close within those lines all the way through from January all the way to where we are right now. So about 5 months of a choppy market, but you can see how long this thing trended for. It trended for, you know, quite some time, over 5 months, about 5.5, 6 months. It trended. So now we've been in a choppy state for about 5 months. But see, here's the problem with not trading this particular market, or not having a plan to trade this particular market. If you don't trade it during the choppy periods, or you're not at least looking at it during the choppy periods, then you're going to miss out when the market breaks out and starts to trend like this, in this massive trend. A lot of traders got rich, right? Because trends are where the real money is made. But you can still make money in a choppy market. You can make $500 to $1,000 a day in a choppy market if you know what you're doing. So today I want to show you exactly how I deal with a choppy market. Now, I'm more of a position type trader, which means that I'm going to be holding my trades for anywhere from 4 to 30 days. Position swing type trader, anywhere from 4 to 30 days. And a big trend like this, obviously, once we catch on to this trend, we can hold this trade for quite some time. Back here, we had what we call a continuation trade, and you can look and see that continuation trade. I mean, that was a massive one, and that trade was over. If you held this trade out, it was over almost 2 months long. And so that's 60 days right there in that trend, 60 full days, not trading days, about 40 trading days in that particular trend. So once again, 4 to 30, sometimes longer days, actual market days. And that's really what we're shooting for. Sometimes less, sometimes more, but on average. Now, as we blow this chart up, let me show you where we are right now. As this market enters into a really choppy period here, I want to show you a way to deal with this. So if you're trading on the daily chart, notice it enters into this choppy period. And one of the ways you can tell that a market is going to start trading sideways is when you start getting these big candles, these big bars, and these big wicks all centered around our 50 exponential moving average line. Now, I use the 50 exponential moving average line in order to really determine the trend. So when we're trading and we're bouncing in between this 50 exponential moving average line with these big bars, these big candles, and these big wicks on these candles, we know we are in a choppy market. Now, one of the ways that I stay out of trades in a choppy market, for instance, like on the daily chart, if I was trading this big trend here, well, I'm going to keep trying to ride this trend until I don't have any ability to trade it anymore. One of the ways that I stay out of a choppy market, first of all, I try to only take trades in the direction of the trend. So here, I'm only taking buy trades because the trend really hasn't changed. It's still up. The 50 exponential moving average line is still up. This market has been in an uptrend. So that's one thing. Number two, when I'm looking to take buy trades on breakouts, I'm very cautious about how I do that. So one of the things that I do is, notice here we had a high here, then we had a lower high form right here. Well, a lot of traders, what they would do is they would take this first break of this lower high right here, but that's not what I do. If I'm going to take any break, it's going to be at this higher high. So what I have to see is, if I have a lower high form, I have to see that high broken and another higher high form. So for instance, I had a higher high, lower high, then boom, I had another higher high form right here. Now I could take that as my breakout point. So if I wanted to move this line up, I can move this line up and say, okay, this is now my breakout point. I'm going to take a trade, any trade above that breakout. Now, notice I had another lower high, okay, then followed by a higher high. Now, I can move this down even further and say, okay, that's going to be my breakout point. Now, notice here I had a lower high. Once again, I'm not taking that particular breakout, but now this could be a possibility of a breakout trade right here. This buy right here, breaking above this high, now I'm long the market, right? So if I'm just looking to trade the daily chart, once again, then that's the way that I would do it, especially in a sideways or choppy market, or if I'm looking to continue to buy with the trend. I want to make sure that I am buying in the correct spots and I'm not buying and then I'm going to have the market whipsaw back against me. Now, sometimes that still does happen, but at the end of the day, you're going to have a lot higher chance when you follow that rule of higher high, lower high, then it's got to be another higher high. Once again, higher high, lower high, another higher high forms. Now I can use that as a breakout point. Lower high, another higher high forms. Now I can use that as a breakout point. See, these are lower highs than these previous highs, but they're closer to the center of the market here. This is where no information is in the market. If the market just had no incoming information, the market would be trading right along this line here. It would just be flat right here, right? It would just be completely flat. So the closer I can get to entering the market to that flat point, while at the same time not taking the risk of being whipsawed out, the better off I'm going to be. The more profits potential that I have to make, the less my risk is going to be. So that's the key right there. Now, secondly, how do I trade this particular market if I'm still wanting to trade this market during this period of time? Well, there is a way to trade a choppy market without you having to risk a whole lot, so on and so forth, and with you being able to actually make really good profits. And the way to do that, of course, is if you're looking at the daily chart and it starts to go into a choppy cycle, like I said here, you've got these big long candles with these big long wicks all centered around your 50 exponential moving average line, which is kind of like the center line here. Then you can begin to look at taking what we call reversal trades. This is what we would consider a reversal type market, where we're bouncing in between a particular range and the market hits that range and then reverses, hits that range and then reverses, so on and so forth. So when I begin to see these big candles here, I know, and then I begin to see these big reversal bars, these bars that have these long wicks, and then they close up towards the high or the middle of the candle, something like that. Now I'm going to begin to see a pattern here that I can begin to, profit from this particular market. So let's say we had that happen. We had a bounce here. We had another bounce here. And then we had a break above this high here. Right around this April 20th area, or April 10th area, when I get this next reversal candle in the daily chart, roughly April 13th, now I can begin to look to take trades that are both buy and sell trades in this choppy market. And the way that I do that is I drop down to the 4-hour chart. Now, you got to get up here to April 13th. Right around this area, that's where I saw that big drop right here in this April 13th. Now I can begin to look at taking either breakout trades to the downside, right? Or I can begin to look for taking reversal trades, all right? Now, the breakout trades, of course, they're just going to be breaks of the lower lows, right? I've got to have a good risk to reward ratio, something like that. If I'm attacking these lows here, right? If I'm staying within this particular area right here, I've got my area drawn on the screen here, but if I'm staying within this particular area, the previous high, previous low kind of area here, then I've got my targets in mind, okay? So here we have low, and boom, I could have taken this trade, although that's probably not a very good reward to risk ratio if I'm going to have to place my stop back above these highs here. There are other ways, of course. Now what we want to look for is what we consider reversal type trades. So here around April 20th, you can see that we had a nice reversal candle. At the same time, look at our stochastic line, okay, down here at the bottom. The stochastic is going up. It's making higher lows while the market is moving down. It's making lower lows, okay? So now we've got an opportunity to potentially take what we consider reversal signals. But how do we do that, once again, and not get whipsawed or chopped out of the market? Well, one of the ways we do that is we filter it. So once again, we can either filter it via having the stochastic be below the 20 level, or we've got this nice higher lows on the stochastic while the market's making lower lows. Then we find a nice reversal type bar like this one, where we had a long wick down, closed right up where it opened. Then we need a break above that. Then we need the market to go further from there. So break above that would be this high right here. It closed above it. We can take the trade on the break above that, and then once again, just follow it the same way. Find the next reversal candle. This one was perfect because this is actually an intermediate term high that formed right here. Once this particular candle formed with a lower high right here, this had a high of 119 or 120.085. This had a high of 120.091. Once that had a lower high and it closed as a reversal type candle, we could immediately take a sell right there. If you notice the stochastic, once again, it broke above the 80 level here, and then what's it doing? It's sloping down now at this candle that makes almost the same high, right? So it's not making the same high here, it's sloping down. That is another opportunity to take a sell. Once again, here's one. Look at where the stochastic is. It's below the 20. Here's a reversal bar, but at the same time, it doesn't always work out. You can see here, price took off. It did take off. We could have had a break above this high right here. Price did take off, but then notice it came back down. Well, that's where we need to play it smart, and once we get a break-even opportunity here, we can get out of the market, or we can just hold on to it, and of course, eventually, we get stopped out. But that's okay. We just had a couple of good winning trades. Keep going forward. You can see, once again, what am I talking about here? Look at the lower the lower low on stochastic, the higher low right there on stochastic. Then once again, you have another large reversal candle here, followed by a what we would call a strong bullish candle here. And of course, price takes off to the upside once again. Here, same thing. You've got higher highs on price, lower highs on stochastic. Right here is a nice big reversal with a push down. You could have entered that market on the next candle for a nice little profit here as well, or at least a break-even trade once we close back above this 50 exponential moving average. And this just continues to go on and on and on. So here we had a false one. This one was a nice reversal, but notice it did not break. The market did not break the low of the next candle before we broke the high of this candle. But here's a nice one right here. 1, 2, enter right here. The market drops nicely, beautifully. Then we have another reversal here. Once again, lower lows on stochastic, higher lows on stochastic, lower lows on the market right here. You can see. If I just draw a little ray right there, you can see that. And the same thing here on stochastic. Here is the market going up like that on the stochastic. You have a reversal candle, you have a break above the high, the next candle you can enter the market, and boom, it takes off, and then it takes off with a nice big run right here, as you can see. So that is a way to trade and stay out of actually choppy markets. It's a way to stay out of it. What I showed you on the daily chart, this is a way to trade it on the 4-hour chart. And that's what we want to be doing. Once again, this is not rocket science. It's very easy to do. Notice I don't have a whole lot of fluff on my charts. I don't have a whole lot of indicators. This is very, very simple. These are very simple techniques. You just have to be able to mentally see this, recognize these type of patterns, recognize what the market is doing, and then execute on it. Be able to take action. And you can turn this into $500, $1,000 or more a day based on your account size, obviously, based on how much you're trading, how much your risk tolerance is. But you can turn this into a $1,000 a day business, and you can do it fairly quickly if you follow these particular types of ideas. Now, once again, I encourage you to check out the email that I sent out today. It has some more information about trading choppy markets. We'll see you soon.